Tired of volatility? There's 5 proven alternatives that generate consistent, secured returns for accredited investors. The stock market can be a mess. Volatility can run wild. Well, in this video, we're going to go over how accredited investors are finding predictable cash flowing returns here in 2026 without ever touching Wall Street. First one up, real estate debt funds. This is where you're acting just like a bank. You're lending in first mortgage positions and you're coming into a debt fund or a co-lending fund. So somebody's operating this for you and you're coming in as a passive investor. The benefit of this is hands off. It's totally and truly passive. Rates of return can vary anywhere from 8 to 12%. So it looks a lot like an equity return, but the predictability of much more like a bond. Number 2, private credit or bridge notes. Well, this looks like you actually lending money. A little more hands-on because you're going to lend money and underwrite folks who need to borrow money. The benefit there is you got more control. And some people want just that, but it does come at a cost, right? You're going to be more hands-on. But you can end up with a higher rate of return, anywhere from 8 on the low end, maybe 15 on the high end, maybe even a little higher. Consistent income. These are backed by collateral again, and you end up with monthly interest payments that are taking place. Number 3, real estate syndications. Private real estate syndications can be fantastic. You're typically involved on the equity side there, so they are a little longer term. You may end up with 2 to 10 years investment criteria. And 2 might be a little short, maybe more like 4 to 10 years on average. Now you can end up with income and typically end up with appreciation there. So it is a longer term play. Number 4, equipment leasing funds. Now these are fantastic. I like these a lot because they're essential assets. You can end up with cash flow on these things, right? Big giant companies end up leasing lots of things and they're asset backed. They are a little different because typically it's not real estate. They're leasing actual equipment. So there can be a little more risk associated with that. Last one, short-term treasuries or high-yield savings accounts. You end up with rates of return that look more like 3 to 5% maybe, but the benefit of there's tremendous liquidity. You can get your money literally tomorrow if you need it to go into something else. So Wall Street's optional. Predictable returns do not have to be optional. And if you want to see how we create debt funds to generate consistent income backed by real property, I dropped a link in the description below.